Morning, everyone. We can start now. The others, they'll join in when we've already started. So today we are going to be looking at the chapter on international flow of funds and also the chapter on international financial markets as well. So remember, when you look at international financial management, we said that we're going to be looking at it from a financial management of a multinational company or corporation's perspective, right? So which means we need to find out exactly. So from a multinational corporation's perspective, what really are the factors that affect their operation, so that you are now going to be able to understand or comprehensively say, how do we now determine the financial flows between the company's parent company's home country, and also wherever it's going to be transacting as well. And one of the issues that needs to be taken into account is understanding the flow of funds when you look at it from an international perspective. So if you look at chapter 2, they say international business is facilitated by markets that allow for the flow of funds between countries. The principal international transactions are borrowing from abroad, lending abroad, investing in foreign shares, setting up foreign subsidiaries, paying dividends to foreign parent companies, payments for imports and receipts of exports. The balance of payments is a record of these international money flows and is discussed in this chapter. So the financial managers of the multinational corporation monitor the balance of payments so that they can determine the nature of international transactions for a particular country and how they are changing over time. So the balance of payments is an indicator of the health of the economy and may even signal potential shifts in exchange rates as well. So now we need to find out exactly, so what really is this balance of payment? Please take note, when we are looking at the balance of payment, we are not going to look at in detail on the line items that makes up the balance of payment, because I don't feel the lecturer is going to be asking you questions based on that, mainly because it's more, we are now going too much or a bit in depth when it comes to economics as well. So what we're going to be concentrating more on is looking at it from a balance of payments to say, at the end of the day, what do you analyze, or what is your conclusion on your analysis of the overall balance of payments as well? So that you're able to now see exactly how are you now going to be able to say, okay, fine, what are we expecting the exchange rate to go in this direction? Mainly because the movements in the exchange rate can either positively affect your investments, your valuation of the investment, or can negatively affect the valuation of your investment as well. So on the next page, they look at the balance of payments, and here they say the balance of payments is a summary of transactions between domestic and foreign residents over a specified period of time. It represents an accounting of a country's international transactions for a period, usually a quarter or a year. So for an organization, this will normally entail setting up a company in the country under the commercial company laws of that country. So individuals who earn their income and live in the country are residents, though they might be foreign nationals. So a business that is resident is registered in the country and is a legal tax-paying entity. So such businesses include all the national companies for the UK, British Petroleum PLC, Tesco PLC, Barclays Bank PLC, and so on, are resident companies, because they're looking at it from what? From a Britain's perspective as well. So here they say subsidiaries of foreign nationals are also residents in the UK, like any other registered company in the UK as well. So when you look at foreign currency transactions, we see that here we have we're given this diagram, which gives us a summary of the foreign currency transactions, where they say you have the home currency, which is the currency held by residents of a country. And in this case, they tell us that the home currency offered mainly to buy goods or to invest abroad, right? So we use the home currency to buy goods or to invest abroad as well. So which means in this case, transactions recorded as in the balance of payments as well. So which means from a UK perspective, for every pound supplied for foreign currency, which basically means that we're going to be losing out, we're going basically spending a pound. Because for every pound supplied for foreign currency, it basically means that we have an outflow of what? Of the pound in this case. So that's basically the transaction. Then for home currency demanded by non-residents to buy goods from the home country or to invest in the home country. So these transactions are recorded as plus in the balance of payments. So £1 must be demanded by foreign currency, which means this is where we're basically saying that there's basically a demand for the pound in the foreign market. So which basically means that it's basically an inflow to us. So which means when you look at it from a foreign currency point of view now, here they say this is the currency held by residents of a foreign country. So the amount of foreign currency depends on the exchange rate. So this changes on a daily basis. So which means ideally the transactions should balance as what? A total of what? Of zero, because you have an outflow and an inflow. So because you had an outflow and an inflow, we're basically saying that if you are having a situation where the outflow is basically equal to the inflows, this is basically which results in what? Net balance, which is equal to zero. So that's basically the broad perspective of how the balance of payment is basically made up of. So here they say a balance of payment statement can be broken down into various components. Those that receive the most attention are the current account and financial account. And the financial account is also referred to as the capital account. So taking the UK as an example, the current account represents mainly export and import payments for goods and services between the UK and the rest of the world. So the financial account represents principally a summary of investments in stocks and shares between the UK and the rest of the world, investment into the UK and investment from the UK to the rest of the world as well. Then so please take note of what really makes up the current account and the financial account. So with the current account, you're basically mainly looking at what? The import and export of goods and services. And then the financial account, this is basically where you look at the movement of what? The capital amounts as well. So Exhibit 2.2 gives us a typical example of balance of payments transactions. So which means here they say we have international trade transaction with UK as the home country. So which means here we look at the demand and supply of the British pound, and here we look at also the entry in on UK balance of payment as well. So which means in this case, the UK importer purchases radios from Singapore. So which means if it is from the UK's perspective, the UK exporter is basically supplying the British pound to buy the foreign currency so that they're able to buy the radios. So which means in this case, it's a debit or it's a debit entry in the balance of payment. And if the Spanish importer pays UK company for goods supplied, it basically means that there's demand for British pounds because they want the British pounds for them to be able to buy the goods from the Spanish importer's perspective. So which means in this case, it's a credit entry. Then French company pays insurance premium to Lloyd's Insurance in London. So it's a demand for British pounds, so it's a credit entry. Then the foreign workers resident in the UK send money home. So it's a supply of the British pounds, so which means in this case, it's a debit entry. Then the French company buys shares on the London Stock Exchange. So there's a demand for British pounds, which means it's a credit entry. Then the UK company loans money to an American subsidiary. So they're basically, because they want the US dollar, in this case, we're basically spending the British pounds, basically supplying the British pounds so that we're able to get the US dollar. So which means there's a debit entry. Then the Australian subsidiary pays dividends to its UK parent company. So there's a demand for British pounds so that they're able to remit the dividends, in this case, to the UK parent company. So it's a credit entry. Then the Italian company lends money to its UK subsidiary. So there's demand for the British pound. So it's a credit entry. So is there any questions regarding a typical examples of transactions that you'd find under the balance of payment? All right, let's continue. So remember we said on the balance of payment account, we are the two main accounts that we're expecting to find there is the current account and the financial account. And the financial account, they also refer to it as the capital account. So here they say, under the current account, they say, if you read from the first sentence, they say, current accounts are described in various ways in different balance of payments accounts. So the distinguishing feature of current account transaction is that they are international payments for goods and services between nationals and non-nationals. Then the financial account is the key component of the financial, the key components of the financial account, sometimes called the capital account, are direct foreign investment, portfolio investment, and other capital investments as well. Then when you now look at the overall balance of payments, they say the balance of payment account can be described in three broad categories. Current account in surplus or financial account in deficit, current account in deficit or financial account in surplus, or current account and financial account not in balance. So these are the three ways that you can expect to the balance of payment account to take form. So they give us a typical balance of payment account in this case. I don't expect you to know too much in detail when it comes to the line items, but what you need to be able to now take note of to see exactly, so what is really happening when it comes to the current account and also the financial account as well. So if you look at the current account in this case, they give us those transactions, and then you see that the balance of the current account is basically a negative, which means that they were sitting with the current account what deficit in this case. So which means that's basically the net amount between the transactions. Then we also look at the capital account as well. And then when you look at the capital account, which is also referred to as the financial account, they are giving us a positive amount in this case. So which means that it basically means that the financial account is in surplus. So remember, if you look at the typical outcomes that you can expect when it comes to the balance of payment, remember they say the balance of payment can either have a situation where the current account is in surplus, the financial account is in deficit, or the financial account is in deficit and the current account is in deficit and the financial account is in surplus, or the current account and financial account are in balance, which means that if they're in balance, this is basically where you look at the net amount from the current account and the net amount on the financial accounts are basically resulting in what net effect of zero. So which means that if it's positive, the other one can be negative, or if it's negative, the other one can be positive. But now we can also have a situation where they can now net off each other, where it results in a net effect of what? Of zero. So in this case, we also look in balancing of the balance of payment account as well. They are also giving us a situation where they're saying that we can also try to correct for the error terms as well. Then this will give us the net effect on the a balance of payments account as well. So just take note of, so which means that in this case, they say the increase in reserves in foreign currency, where they say it's a net purchase of foreign currency, hence similar to say imports, which means that the net effect in this case, if it's negative there, it basically means that the net effect here is that what we effectively imported more than what we basically spent more in buying foreign currency than what we received from what foreign currency transactions as well. So don't worry much about the line items of the balance of payments. What I would say, what you need to take note of is basically the interpretation of exactly the possible outcomes of what you can expect to happen when it comes to the balance of payment accounts. Is there any question regarding this diagram? Any question? So referring to this diagram, they say, if you look at a situation where the current account is in surplus and the financial account is in deficit, so here they say, ideally, one would want to see the balances in these balances in a developed country. So remember, this is basically the situation where the current account is in surplus and the financial account is in deficit. So here they say, the mature economy should be able to generate surplus goods and surplus savings. So a surplus in the current account would be expected from such a productive economy, more exports of high-tech, high-value, added goods, and imports of low-tech goods and raw materials. So the consequence of a deficit in the financial account means that there is a net demand of foreign currency. So such demand would be required if a developing country were to invest in its surplus savings in developing country. So we're basically saying that they are the situation where the current account is in surplus and the financial account is in deficit is basically where we are saying that you find it more in developed economies, mainly because look at it this way from a practical perspective. This is a situation where you find that, for example, Africa, we export a lot of raw materials to other developed nations. Like, for example, we export raw gold, raw diamonds. We export raw, for example, minerals, basically to the developed countries. And what do? They process these minerals into a finished good. Then now they export back those goods back to countries like what? Countries like Africa as well. But now they've basically created more value. So because of this, you are seeing this is what would result in a situation where your financial account is in deficit because you're importing more of the raw materials. And then your current account is in surplus mainly because those raw materials are now, the finished good, you're now exporting it to other countries. So you usually find this in the from the perspective where you're looking at it from what? From a developed country's perspective as well. Are we on the same page when it comes to the first scenario where the current account is in surplus and the financial account is in deficit? Any questions? The second scenario, they say this is where the current account is in deficit and the financial account is in surplus. So reflecting the previous discussion, this result could be a good scenario for a developing nation. The current account deficit would ideally be due to imports of machinery, and the finance for such imports would be through international borrowing, resulting in a surplus on the financial account. So a deficit on the current account can, however, all too easily be due to high interest payments on loans or import of relatively unproductive goods. So this is basically what would result in a situation where we have a current account deficit and financial account in surplus. Are we on the same page? Any questions? The next scenario is where the current account and the financial account are in balance. And here they say the balance of payments must be seen within the context of the economy as a whole. So being in balance is not an especially desirable goal, Large deficits and surpluses may be quite small in the context of an economy as a whole. So it is quite possible for a country to maintain a current account deficit in much of the same way as a company can sustain an increasing overdraft at its as it's what grows in size as well. So you can also have a situation where they're in balance, but basically it means that it's not really that desirable, mainly because it basically means that you are not able to achieve a lot of economic growth when your current account is what is in balance, ideally. So which means here, that's why they say when you look at so if you look at it from a perspective where the current account is going to be in deficit, it basically means that in this it can be a situation like, for example, due to a situation where, for example, from a company's perspective, you're basically running an overdraft facility, which means that you're able to now, if you're running an overdraft facility, you're basically utilizing more debt financing. And if you're utilizing more debt financing, it basically means that we know that the more debt financing you're able to achieve, as long as you're able to productively utilize the financing, you're able to achieve what? Economic growth at the end of the day. So are we on the same page when it comes to the balance of payments? So please take note of the balance of payments. Don't worry much about the line items that you find in the balance of payments. Worry more about the interpretation of the different outcomes that you can expect from a balance of payments, those three outcomes. Any questions? On the next section, they look at international trade flows. I'm not going to look at this in detail because remember, if they're going to be giving you a question, they'll give you a case study, and based on the case study, you are asked to actually analyze that trade flow as well. So I wouldn't expect them to now know for you to know historically what is the trend when it comes to the trade flows. You don't have to worry much about that. So here they say, France, UK, Germany, and other European countries rely more heavily on international trade than the US. The trade volume of European countries is typically 30% and 40% of their respective GDPs. So the trade volume of the US and Japan are typically between 10 and 20% of their respective GDPs as well. So that's why you see that if you look at trade flows, that's why you see that the European countries are finding it very difficult to have a situation when it comes to the issue of what are imposing sanctions on Russia as well, mainly because they basically rely a lot of their trade flows on what to be trading with Russia, especially when it comes to the issue of energy as well. So the breakdown of how the trends are historically between the different countries, don't worry much about those figures. Would not expect the lecturer to ask you all this information in detail, because we remember your exam questions are going to be based more from a South African perspective and not from a European or international countries perspective as well. So because the questions are going to be based more from a South African perspective, don't worry much about that. It's a section where they look at the breakdown of the trade flows when you look at international European countries and also other international countries as well. Don't worry much about that. I don't expect that section to be coming in the exam, because your exam is going to be more based on the South African perspective, not the UK perspective. On the next section, we look at factors affecting international trade flows. And here they say, if you read it from the line just below under that heading, they say, because international trade can significantly affect a country's economy, it is important to identify and monitor the important factors. The most influential factors are inflation, national income, government restrictions, and exchange rates. So please take note of this, because you can potentially be asked this as a theory question in the exam. So this is a potential theory question in the exam. So looking at it, now looking at the breakdown of the effect of inflation, they say, when you look at the impact of inflation, they say, If a country's inflation rate increases relative to the countries which it trades with which it trades, its current account will be expected to decrease, other things being equal. Why? Mainly because, remember, we are looking at, when we talked about the current account, we said the current account looks more at the what, from the perspective of what, import of and exports of goods and services, right? Now, when the current account is decreasing, it basically means that we have a net negative, which means that we spent more than what we got in, isn't it, right? Why would that be? When you look at inflation, by definition, inflation is the general increase in what? Cost of goods and services. So what does that mean? It basically means that if inflation goes up relative to our trading partners, what is going to happen? Our goods and services are going to become more expensive, isn't it? And if our goods and services become more expensive, what is going to happen? We have a situation where foreign customers who are supposed to be demanding our goods are going to find it better to actually buy from other sources or from their domestic market, mainly because it will be cheaper for them. Because when the inflation goes up, it means now they're having to spend more of their. It basically means that when they exchange that money for the domestic for our domestic currency, they're going to end up spending more money, right? So what does that mean? It basically means that the demand for our goods and services is going to be less. And if the demand of our goods and services is going to be less, it means you're expecting the domestic currency to depreciate against the foreign currency. And so in this case, what does that mean? It basically means that the moment you see that our goods are becoming more expensive compared to our trading partners, it basically means that they are going to be buying less from us, and our demand of their goods and services is going to remain whatever if the same, or it might end up increasing as well. So because of this, what is going to happen? Would result in a situation where the current account is going to be having a decrease, mainly because there's a decrease in the demand for our goods and services, which means that we're going to be exporting less. And if we maintain our imports, it basically means that we're going to be having a situation where the current account is going to be in deficit. Are we on the same page when it comes to the effect of the inflation? Are we on the same page? Any questions? Next factor is the impact of national income. And under national income, they say, if a country's income level increases by a higher percentage than those other countries, its current account is expected to decrease, other things being equal. So if our income level, which basically means that if our income level, like for example, income level, we're looking, for example, people making people earning more money in being paid more in salaries compared to other countries as well. So what does that mean? We are expecting a situation where our customers have more excess funds available compared to our trading partners. So what is going to happen? If our supply of the goods and services does not satisfy them, they are more likely to now start importing goods and services. So if they start importing goods and services, it will result in a situation where the current account end up decreasing, because we're spending more money to buy the foreign currency than what we are getting from our trading partners as well. So if our income levels go up, we're expecting more demand of the international goods and services as well. So we're going to be demanding more of the foreign currency, which means that it will result in a deficit. Next, we look at the impact of government restrictions. And here they say, a country's government can prevent or discourage imports from other countries. By imposing such restrictions, the government disrupts trade flows. Among the most commonly used trade restrictions are tariffs and quotas. So which means when you look at tariffs and quotas, this is basically where we're saying that if a country's government imposes tax on imported goods, the price of the foreign goods to the consumer are effectively increase. So which means if a government imposes tariffs, it means it's going to be more expensive for our customers to import goods, isn't it? So which basically means that in that case, we are going to have a situation where there's less demand for those goods and services from abroad. Then they also talk about, they say on the next paragraph, they say, in addition to tariffs, government can reduce its current country's imports by enforcing a quota or a maximum limit that can be imported. So another way that they can restrict the demand for goods and services from abroad, or they can restrict import of goods and services from abroad, is through quota. So with the quota system, basically means that they basically saying that overally, for a particular good or service over a given period, we are saying that the maximum that we're going to be able to allow to be imported is so much. Beyond this point, we're no longer going to be allowing imports of those goods and services. So what is going to happen? It means beyond this point, the demand for the goods and services from abroad is going to go up. So that's one way that they can try to look at use of restrictions to actually try to balance off the balance of payment so that we're not going to be too much on the deficit when it comes to the current account, or even the capital account as well. Then we also look at other types of restrictions. This is where you look at some trade restrictions may be imposed on products for health and safety reasons as well. So because the government might be saying that this product might not be good for health and safety reasons, so which means that they can now impose trade sanctions on a particular product as well. So is there any question when it comes to the impact of government restrictions? Any questions? On the next section, we look at the impact of exchange rates. So we look at the impact of exchange rates, and the impact of exchange rate is basically summarized on this exhibit, which looks at the impact of exchange rate from a UK's perspective. So exhibit 2.8, they give us the current account balance for UK, the effects of exchange rates are revaluation and devaluation. So initially, we look at a situation where the current spot exchange rate is 1.4 euros is equal to 1 British pound. So 1.4 euros is equal to 1 British pound. So if the pound depreciates, this is where we are needing less euros for the British pound. Because initially we need 1.4 units of the euro to get 1 British pound. Now we need only 1.2 units of euros to get the British pound. So which means the moment you see that we're needing less of the foreign currency, it means our currency is depreciating against that foreign currency. So here they say, so this is a situation where the pound is considered to be devaluating. So when you get the devaluation, they say this is the decrease in the value of the pound in relation to other currencies. So which means now, what is the effect of the devaluation of the pound? It means imports are more expensive, demand falls, and a probable fall in the total cost of imports. Because initially, with £1, we were able to get goods and services which are worth 1.4 euros. But now with the same pound, we are only able to get goods and services which are worth 1.2 euros. So which means that in this case, our imports are becoming more expensive. Because initially, we're able to buy more with because for £1, we're able to buy more. Now we're able to buy less. So here they say, the exports are cheaper for foreign buyers, demand increases, and certain rise in pound value exports. And at the same time, if the pound devaluates, we're basically saying that we might also have a situation where our goods are becoming cheaper because from a foreigner's perspective, to the British pound, initially to buy goods in the British pound for which are worth £1, they were having to spend more. Now they're only having to spend less. So because of this, it basically means that you are expecting the goods to the foreigners to be cheaper to the foreigners, which means that we're expecting the foreigners outward to basically export. We're expecting to export more because the foreigners are deeming our goods to be less expensive. So when you look at the current account probable effects, they say there's a probable current account improvement because we're expecting to export more and import less. Then, if the British pound devalues, so if the British pound devalues, if the British pound if we have any revaluation of the British pound, this is where we say the British pound is appreciating in value. So if there's a revaluation of the currency, this is where we're saying that our currency is appreciating in value. So which means here we're saying initially for 1 British pound, we're able to get 1.4 units of goods in euros. Now, for 1 British pound, we're able to get 1.6 euros as well. So which means that we're able to get more money in euros than what we had done previously. So this is basically means that the British pound is appreciating in value, mainly because we are able to actually we're able to actually get more units of the foreign currency than previously. So here they say an increase in the value of the pound in relation to the other currencies. So here they say, so the imports are cheaper, demand increases, and probable rise in total cost of imports. So because imports are becoming cheaper, because for 1 British pound, we were only able to get 1.4 units of the euro. Now we're able to get 1.6 units of the euro. So which means that if we're able to get 1.6 units of the euro, we're able to buy even more goods in euros. Which means that we're expecting our imports to increase. But at the same time, the exports are more expensive for the foreign buyers. So demand falls and certain fall in pound value exports. But now, because from a foreigner's perspective, they only needed 1.4 units of the euro to get 1 British pound. Now they need to get 1.6 units of the euros to get 1 British pound. So it means that it's becoming more expensive for them to buy the British pound. So what does that mean? We're expecting a situation where our imports are becoming cheaper because we're spending less. We're basically getting more when we exchange the pound for the euro. But at the same time, the foreign customers are able to get less when it comes to, because they need to raise more money to get 1 unit of the British pound. So which means that our exports are expected to decrease, but our imports are expected to increase. So because of this, we have a probable current account worsening. So basically, we're expecting a worsening of the current account. Probably we're expecting to have a situation where the current account is basically worsening, where we're saying that there is an increase in negative and a decrease, or probably and a probable decrease not in the positive as well. So which means that in this case, we're expecting the current account to worsen at the end of the day. So are we on the same page when it comes to analyzing the balance of payments from a perspective of the devaluation and also the revaluation? Any questions? On the next section, we look at correcting balance of trade deficit. So we look at correcting the balance of trade deficit. So remember, when we look at the balance of trade deficit, this is where we are looking at a situation where we are importing more and exporting less. So here they say, a balance of trade deficit is not necessarily a problem It may be that a country's consumers benefit from imported products that are less expensive than locally produced products. However, the purchase of imported products implies less reliance on domestic production in favor of foreign production. So thus, it may be argued that a large balance of trade deficit causes a transfer of jobs to some foreign countries. So consequently, a country's government may attempt to correct a balance of trade deficit in the current account. Then on the next, if you skip the next paragraph, they say, a floating exchange rate could possibly correct any international trade imbalances in the following way. A deficit in a country's balance of trade suggests that the country is spending more funds in foreign products than it is receiving from imports to foreign countries. So because it is selling its currency to buy foreign currency in greater volume than the foreign demand of its currency, the value of the currency should decrease. So this decrease in value should encourage more foreign demand for its goods in the future. So while this theory seems rational, it does not always work as just described. So it is possible that instead a country's currency will remain stable or appreciate even when the country has a balance of trade deficit. So the negative balance of the current account can be sustained by positive balance in the financial account, representing a net inflow of investment to the country. So this is why you see that many developing nations, they rely a lot on what? Foreign direct investment, mainly because they usually have a situation where their current account is in deficit. So for them to be able to have sustain going into the future, they are going to be relying more on what? More imports of what? More inflow of what? Of capital going into the system, so that if they are going to be having a negative or a deficit on the current account, then for them to be able to have sustainability, that's why you see that they rely a lot more on what? On inflows through foreign direct investments, or they are very much interested or very much dependent on the foreign direct investment as well, so that they're able to manage their balance of payments. So on the next section, we also ask the question, so why a weak home currency is not a perfect solution? So we also look at the situation where we're saying, so why is it that a weak home currency is not a perfect solution? Because initially we saw that they were also saying that a weak home currency is not necessarily a bad thing. It can be a good thing, because it can be a good thing mainly because if we have a weak home currency, our goods and services may be deemed to be cheaper, and because of that, we can expect what? More demand of our goods and services as well. But here they also say, even if a country's home currency weakens, its balance of trade deficit will not necessarily be corrected for the following reason. The demand of imports and exports may be too inelastic. So here they say, as discussed above, devaluing a currency does not necessarily mean that the increase in the quantity of exports and the reduction in the quantity of imports will offset the increase in what? The price of the imports. So you might have a situation where the demand of imports and exports may be too inelastic. Like, for example, there can be a situation where the goods and services, they are not necessarily going to be responding to this to this weakening of the home currency as well. Mainly because you might have a situation where these goods and services, they are too inelastic, in the sense that whether whatever happens with the movements in exchange rate, people are always going to be needing that those goods and services as well. So because of this, even if for example, if our home currency weakens and we know that we need a particular drug from another country abroad, the demand is not necessarily going to be weakening, mainly because it's a life-saving drug. So we are also going to be expecting that even if it becomes more expensive, the people are still going to end up spending whatever amount is needed there for that particular product, goods or service as well. Then there's also the issue of counter-pricing by competitors, where they say when a country's currency weakens, its prices become more attractive to foreign customers, and many foreign companies lower their prices to remain competitive with the country's firm. So this is another situation where even if our currency depreciates against the foreign country, the companies, especially in the industry where there are few firms operating in that particular country as well, when there is a situation where we are basically having a trade with one particular country as well, in most cases, or a few countries. So you have a situation where when you look at the counter pricing by competitors, this is where our competitors might realize that, okay, fine, our country, our currency is depreciated in value. So what do? They now look at the net effect or the effective effect of on the cost of their goods and services because of the movement in exchange rate. So whatever percentage would be caused, or the whatever percentage of that would be causing the difference between the price of the goods here and the price of goods abroad, they can now be netting off that effect by by also lowering their prices there by a certain percentage of due to the movements in exchange rate as well. So because of this, it means that the customers from abroad would now be indifferent between the buying here or buying in their home currencies as well, because the suppliers in their home currencies, our home countries, they would have reduce their prices as well. Then we also look at the impact of other weak currencies. And here they say the currency does not necessarily weaken against all currencies at the same time. So which means that we might have a situation where our country's currency is weakened and other countries' currencies is also weakened as well. And because of this, we can also end up having a net effect where the weakening of our currency and the weakening of the other currencies as well ends up having a situation where the net effect becomes becomes zero. Then another issue would be pre-arranged international transactions. And here they say many international trade transactions are pre-arranged and cannot be immediately adjusted. So thus, a weaker British pound may attract foreign purchasers who cannot immediately sever their relationships with suppliers from other countries. So it cannot, so it means a weaker British pound may attract foreign purchasers who cannot immediately sever their relationship with suppliers from other countries, which means that they're going to be forced to have a situation where they are still going to be bound by those relationships. Like, for example, if there's already a contract to say we're going to be buying or we're going to be buying where the customers are going to be buying goods and services for over a given period of time, and there's a contractual arrangement to say we are buying the goods and services at a certain price over a given period of time, it basically means that regardless of what happens with the exchange rate, that arrangement has to be met. Maybe would be due to a contractual obligation as well. So which means that where our currency depreciates in value, it's still not going to end up affecting the customers, because the customers, even if it's attractive to them, they are not going to be able to move between those currencies as well. They're not going to be able to change their demand for the goods and services. Now, looking at this, we also look at the J-curve effect to see exactly, so what might happen in a situation where the currency weakens against other currencies as well. So which means that if the British pound weakens against other currencies as well, what might be the overall effect over time? So here they give us a situation where when you look at the current account balance, it can be positive or it can be negative. And they were looking to see exactly, so what happens on the current account over time as well, where the British pound devalues initially. So here they say we have a situation where the UK devaluation makes imports more expensive and balance of payments weakens. So which means that the balance of payments starts going down, mainly because our imports are becoming more and more expensive. So we're spending more, or basically we're basically having a situation where the current accounts, that's what worsening there is, isn't it? Because the UK, there's a devaluation of our currency, right? Then over time, the imports, they slow down due to high prices. Then what do we expect to happen? Then there's going to be the exports are cheaper and increase because of what our currency is devalued. So after the imports slow down due to high prices, we're expecting the exports to be cheaper as well, and there's going to be an increase in the current account balance as well. Then over time, we're expecting the exports are cheaper and imports more expensive. So there's an improvement in the balance of payment volumes, and the increase and import volumes decrease sufficiently as well. So which means that this is what we can expect as a J effect on the current account when it comes to the devaluation of our currency. So here they say the UK balance of trade may actually deteriorate in the short run as a result of British pound depreciation. So the price effects are likely to occur more quickly than the more favorable quantity effects. And quantity effects, which means in this case, we have a reduction in quantity of imports and increase in the quantity of exports. So this pattern is called the J-curve effect, and it is illustrated in figure exhibit 2.9. So the further decline in the trade balance before a reversal creates a trend that look like the letter J as well. So this is basically the J-curve effect on the current account balance when you look at the depreciation of the home currency. Is there any question regarding the J-curve effect? Any questions?
No, not from my side, sir.
All right. Now, remember we said sometimes this weakening of the currency might not take the intended effect because of the pre-arranged international transactions. So these pre-arranged international transactions can be due to intercompany trade. Like, for example, a parent company trading with its subsidiary. Like, for example, maybe the parent company is the one that is producing the main product that the subsidiary is going to be selling in its countries that it's going to be operating as well. So which means that if the parent company is the one that is producing the product, it means that there's going to be constant trade between the parent company and the subsidiary. So because of this, it basically means that even if whatever happens with the exchange rate is not going to end up affecting the trade between these two companies, between these two entities as well. So here they say, this type of trade makes up more than 50% of all international trade. So here they say, this type of trade makes up more than 50% of all international trade. The trade between the two parties will normally continue regardless of exchange rate movements. So that's the impact of exchange rate movements on intra-company trade patterns is what is going to be limited. Whether the currency appreciates or depreciates in value, it will not have any effect at all on that movements between on the trade between the two entities as well. Are there any questions when it comes to the effect when you look at the devaluation of the countries of the currency? Any questions? On the next section, we look at the international capital flows, and here they say capital flows on the balance of payments refers to investments abroad. So when you now look at what makes up the financial account when it comes to the balance of payments, we are we will see that one of the factors that, or one of the transactions that affects the financial account would be the foreign direct investment. So here they say, if you look at the sentence just below that, they say, capital flows resulting from foreign direct investment change whenever conditions in a country change the desire of firms to conduct business operations there. Some of the more common factors that could affect a country's appeal for foreign direct investment are identified here. The first one being changes in restrictions. So which means if there's going to be any restrictions on the movements of capital flows between countries as well, it will also end up affecting what the movements in what it comes to the capital flows as well, or the financial account. Mainly because in some countries, they have restrictions on exactly what money, how much can be invested in their countries and all those other things as well. So because of this, it basically means that if there's going to be any barriers that are put in place by the government when it comes to foreign direct investment, it basically means that they might end up having a situation what they also end up affecting what the current the capital account. Then another issue or another factor would be privatization, where they say several national governments have recently engaged in privatization or the selling of some of their operations to corporations and other investors. So this is where initially there was nationalization, where the governments were owning a lot of these, a lot of the entities as well. But over time, because of because they are seeking to be more efficient in the running of these entities, they push more towards what? Privatization. And as they push more towards privatization, it basically means that those foreign investors, because they are now able to access a particular company, maybe they might be having an interest in that particular company as well. So because they are able to access and invest in that company now because of what? Privatization, it basically means that you're going to be expecting what? More money coming in as what? Foreign direct investment as well. Then we'll also look at potential economic growth. And here they say, countries that have greater potential for economic growth are more likely to attract foreign direct investment because the firms recognize that they may be able to capitalize on that growth by establishing more business there. That's why you see that we see this quite a lot when it comes to developing nations. That's why you see that there was a lot of news making the headlines when it comes to the president's move towards what? Attracting investments within South Africa as well. Where they were saying that they've now managed to come up with deals worth trillions to actually be invested in South Africa as well. So it's mainly because, especially when it comes to developing nations, we rely quite a lot on the foreign direct investments as well. Then there's also issue of exchange rates, where they say firms typically prefer to direct foreign direct investments to countries where the local currency is expected to strengthen against their own. So which means if you're expecting the local currency in a foreign country to appreciate against their own, it basically means that investors are more likely to invest there, because before they even look at the returns on their investments from the performance of the investment itself, they are able to generate a return through the movement of the currency. Because if they invest there and then they get back that money, before you even look at the returns of what has done with that, what has been done with that money as well, they can be able to actually get more money as well because of what? Movements in exchange rates. Then there's also issue of tax rates, where they say countries that impose relatively low tax rates on corporate earnings are more likely to attract foreign direct investment. That's why you see that one of the things that Donald Trump did when he took over as president in the US was what? Lowering taxes on corporates, mainly because we're trying to now say we want to make America great again. And what do we need to do? Those companies, those American companies that were invested in other countries as well, they were trying as much as possible to actually attract them so that they're able to now move their operations back to the US as well. By what? So they were trying to attract them by use of what? Of tax rates as well. Are we on the same page so far? Any questions? All right. Next, we are going to look at factors affecting international portfolio investment. And here they say, when you look at the first factor that they talk about there is tax rates on interest and dividends. And here they say, investors normally prefer to invest in a country where the taxes on on interest and dividends income from investments are relatively low, because the less the tax on interest and dividends, because remember, you don't have a situation where you are going to be taxed on the dividends in the foreign country, and then you're going to be taxed on the dividends in your home country as well. So which means that the moment they see that the taxes are less, or the net effect of the taxes is less on the interest and dividends that they're going to be earning on their investment. Because remember, when you look at interest and dividends, we are also basically going back to the capital accounting equation. We say your assets equals equity plus liabilities. So which means, looking at this, we know equity, a typical investment of equity is what? Investing in ordinary shares. And the return that you earn from ordinary shares would be dividends. And liabilities, you can either give out loans, or you can invest in what? Bonds. And these two, they generate the return that you are able to generate there is basically interest, which is basically from a bond perspective to be your coupon payments, which is basically interest as well. So that's basically, so which means that the moment you see that the returns, which is dividends to the owner shareholders, if you invest in equity or in debt financing, if it's going to be loans or bonds as well, the returns that you're going to be generating there, the moment you see that these returns are resulting in a situation where you are not taxed that much in your hands as well, when the money comes into your hand as an investor, it basically means that you're more likely going to be attracted to invest in those countries. That's why you see that in some cases, other countries, they try to attract portfolio investors by what? They're having a situation where they give them even what? Exemptions and concessions as well. The next factor affecting international portfolio investment is exchange rates, where they say when investors invest in a security in a foreign country, their return is affected by the change in the value of the security and the change in the value of the currency in which the security is going to be denominated. So there are two factors which are going to be affecting your overall returns. So which means if the moment so you can have a situation where your investment gives you a positive return, but the movement in exchange rate results in in a net loss for you. Like, for example, if your investment gives you a net positive return of, let's say, 5%, but your home currency depreciates by 10%, it would mean overall your investment is going to go down by 5%, even though on where it's invested, it's giving you positive returns. So it can be negatively affected by what? By movements in exchange rates. So you need to take into account movements in exchange rates when you're looking at portfolio investment. On the next section, they look at the agencies that facilitate international flows. On this section, I don't really expect the lecturer to be asking you questions on this. Yes, in practice, you need to know them, but from a Fin4802 exam preparation perspective, you don't have to worry much about them, because I wouldn't expect the lecturer to be asking you this, mainly because it's something, you are going to be looking at it from a multinational perspective, and you're also going to be looking at it from a South African perspective as well. So I wouldn't really expect them to be asking you questions regarding to say, so what is the IMF and what makes up the breakdown? Don't worry much about it. I wouldn't expect the lecturer to be asking questions regarding this. But from a practical perspective, just go through it so that you're able to be knowledgeable when it comes to these agents that facilitate international flows. Are there any questions from chapter 2? Any questions from chapter 2, which looks at international flow of funds? Are there any questions? All right. So This is where we end when it comes to chapter 2, right? So please make sure that you take note of the things that I've emphasized on from chapter 2. Don't go too much in depth when it comes to balance of payment. Just know the interpretation of exactly what is the possible outcomes and the possible effects when it comes to the balance of payments. And also all these other things that we looked at when it comes to international flows as well. Those things that I've emphasized, please take note of them. All right, so can we take a few minutes break until 9:30? Then at 9:30, we're going to look at international financial markets. So can you take a few minutes break until 9:30? Then at 9:30, we're going to be looking at international financial markets. So can you take a few minutes break until 9:30?